Okay, let's dive right into this. Welcome back to our latest explainer. Today we're putting on our expert analyst hats to look at a massive, literally $33 billion transformation that's happening right now at the intersection of global energy and industrial tech. We're talking about Baker Hughes, and specifically their absolutely phenomenal Q1 2026 earnings beat. But hey, we're not just reading the news today. We're actually going to run this company through the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, along with our own DCF modeling to see if this stock is a true definitive buy. So let's get into it. Here is our roadmap for today. We'll be hitting the earnings beat, geopolitics and energy security, the IET growth engine, climate tech and sustainability, and finally, we'll wrap up with the stock valuation and outlook.
All right, Section 1. The Q1 2026 earnings beat, crushing expectations. Let's look at exactly how the market reacted to these numbers.
Boom! A massive 6.9% single-day jump, pushing Baker Hughes right up to a 52-week high on April 24th. I mean, the market didn't just casually accept these earnings. Investors actively validated the company's robust performance and their whole new strategic direction.
And it really wasn't just a one-off stroke of luck. We're talking revenue hitting $6.58 billion, adjusted EPS at 58 cents, and adjusted EBITDA crossing $1.15 billion. They comfortably crushed Wall Street estimates across the board. Now, what's really interesting about this is the consistency. This marks their fourth consecutive quarter of beating both revenue and earnings expectations. For a Warren Buffett-style investor, that highly reliable track record is absolutely crucial before you even start looking at valuation multiples.
But, behind all those spreadsheet numbers is just immense physical, industrial scale. The massive capital and the complex engineering required to build these huge turbines, that creates an incredibly wide economic moat, which is another huge positive in Buffett's framework. We're talking about bespoke, heavy machinery shipped globally to power the world's infrastructure. The barriers to entry for potential competitors here are just unbelievably high.
Moving on to Section 2, Geopolitics and Energy Security, the macro catalyst.
Geopolitical risk is pretty much a structural reality for the energy market now, right? CEO Lorenzo Simonelli actually addressed this head-on. He noted that despite significant disruptions in the Middle East, their teams executed at a high level and still exceeded guidance. Navigating those kinds of disruptions successfully, that points to strong, honest, and highly competent management, checking yet another major box on the Buffett criteria for a long-term investment.
So because of these global disruptions, the whole macro outlook has fundamentally shifted. Oil and LNG balances are tightening globally, and energy security has just rocketed to the top of government agendas everywhere. When we get to our DCF modeling later, this structural shift toward infrastructure resilience is exactly what gives us the confidence to forecast strong, durable terminal growth rates for their free cash flows.
All right, Section 3. The IET growth engine, a tale of two segments.
We're really witnessing a tale of two distinct segments inside the company right now. On one side, the traditional oilfield services generated $3.23 billion, with resilient margins around 17.4%. In Peter Lynch's terms, think of this as the stalwart, or maybe the cyclical foundation. It's steady, it's reliable. But then you have the Industrial and Energy Technology segment, or IET. This side is acting like a true Lynch fast grower. I mean, it pulled in $3.35 billion in revenue and a record $4.9 billion in orders for the quarter, with incredibly strong margins up at 20.2%. Explosive growth, for sure.
And this brilliantly illustrates exactly what management calls their Horizon 1 and Horizon 2 strategic pivots. They are deliberately transforming from a traditional oilfield provider into a leading industrialized energy solutions company. They're actively connecting energy sources with industrial outcomes, literally bridging the gap from molecule to electron.
And here's the wild part. A massive chunk of this IET surge is coming from a totally unexpected place, the AI and data center boom. To put that into perspective, future AI data centers are projected to consume as much power as the entire electrical grid of a small nation. No joke. Because of this, Baker Hughes is literally sold out of their Nova LT gas turbines all the way through 2028. They booked $1.4 billion in power systems orders in Q1 alone. This whole behind-the-meter power market, it could reach a staggering $60 billion by 2030. That is a massive tailwind for their future cash flows.
Let's look at Section 4, Climate Tech and Sustainability, the long game.
So the completion of their Horizon 1 phase proves something really essential to investors. Disciplined sustainability efforts actually enhance overall financial resilience.
By making their operations leaner, they reduced their own emissions while simultaneously delivering record financial performance. This perfectly aligns with Benjamin Graham's defensive investor checklist, which notes that a strong financial condition and earning stability are absolute prerequisites before you even consider buying.
So the crucial point here is that based on long-term announced pledges, a whopping 81% of Baker Hughes business activities are now aligned with climate-related opportunities. Think about that for a second. This is no longer just a traditional oil and gas company. The vast majority of their business is now directly positioned to capitalize on the energy transition.
And this strategy is translating into a tangible, real-world backlog. Just look at these wins. They're partnering with Hydrostore on up to 1.4 gigawatts of compressed air energy storage. They're providing compression for Wabash Valley's clean ammonia facility. Oh, and they secured a multi-year agreement with Marathon Petroleum for renewable fuel additives. These aren't just ideas on a whiteboard. They're real projects generating real revenue today.
Finally, Section 5, Stock Valuation and Outlook. It's time to put all these macro tailwinds and that massive backlog through the gauntlet of our DCF, Buffett, Lynch, and Graham models.
Let's look at intrinsic value, running a base case DCF, factoring in that $33 billion backlog, and forecasting out free cash flows. We arrive at a fair value per share right around that $92 mid-target. Now, if we apply the Benjamin Graham formula, factoring in EPS and book value, his strict intrinsic value might find that 29 times forward PE just a little bit rich for a purely defensive play. But for Peter Lynch, taking that PE and dividing it by their explosive IET growth rate gives us a highly attractive PEG ratio. That means we aren't overpaying for this fast grower expansion. Basically, the market is finally pricing them like a premium industrial tech business.
So this brings us to the ultimate question for our Buffett and Graham acolytes out there. At 14 times forward EV to EBITDA, is there any margin of safety left? Or is this record $33 billion backlog already fully priced into the stock following this year's massive rally? That's the ultimate tension here. Can the massive long-term tailwinds from AI data centers and global LNG expansion continue to outpace the very real near-term execution risks in the Middle East? Blending the insights from our DCF model, Lynch's growth metrics, and Buffett's moat analysis, our final verdict at this current price is a confident buy for long-term growth investors. Though I will say, deep value Graham investors might want to hold out for a wider margin of safety. You're definitely going to want to keep a close eye on the Q2 earnings release to see if that momentum holds. Thank you so much for joining me for this explainer, and keep tracking how this incredible industrial transformation continues to unfold.